the stock market might be down, but that's created a window of opportunity for IRA owners. And here to talk with me about this is Robert Klein from the Retirement Income Center. Robert, welcome.
Thank you, Bob.
So the market's down, but it's created a window of opportunity.
Yeah, that's exactly how I see it. And I'm always looking for windows of opportunity for my clients to leverage and protect their assets with the goal of optimizing their projected after-tax retirement income. And one of my favorite windows of opportunity is using a staged Roth IRA conversion plan. I've been very successful with using that during market downturns, especially in bear markets like we're experiencing now. And so what is a staged Roth IRA conversion plan? It's a sub plan within a holistic retirement income plan. You have your various plans such as housing wealth, maybe you have an insurance plan. This is just another plan, a staged Roth IRA conversion plan. In this case, it's a strategic multi-year plan that's used to optimize the projected longevity of one's assets, and once again, is part of a holistic retirement income plan. And the purpose of doing this multi-year approach is to minimize the tax liability compared to what you might pay if you did a single Roth IRA conversion, which generally for most Roth IRA conversions is not recommended.
Right. So you say that the primary purpose is to eliminate taxation on the growth of converted assets. Can you give us an example how that might work?
Yeah. And the reason you want to eliminate the growth on the assets is because the entire value of the Roth, including appreciation, which generally is the majority of the value of the plan, is exempt from taxation. So as an example, let's just suppose you went back a year ago and we had a 1 month bear market. It was the shortest bear market on record, began on February 19, 2020, ended on March 23rd, 2020. And so let's say you invested $100,000 in the S&P 500 index on that date. The index would have fallen by 34%. And so your $100,000 today basically would be up 86% and would be worth $186,000. So that's an example of taking advantage of a window of opportunity to do your Roth IRA conversion.
Right. So why might someone implement a staged Roth conversion plan?
Yeah, great question, Bob. You have to look at what you're investing in now. Let's say you have a qualified retirement plan, a taxable plan, like a traditional IRA, a SEP IRA, or just a traditional IRA. The reason you do those kinds of plans is because you get an immediate tax deduction for doing that, and your assets grow tax deferred so long as they remain in the plan. That's the good news. The bad news is that 100% of the contributions you make to the plan and the appreciation is going to be subject to taxation from the moment you begin taking distributions until all assets have been distributed. And once again, appreciation is typically responsible for the majority of the growth of value of retirement plans. So if you're looking at it from a long-term perspective, if you don't do strategic Roth IRA conversions, the amount of tax liability attributable to your distribution can exceed the tax liability that you would incur by doing a staged Roth IRA conversion plan. Basically, I look at it as leveraging. Just like when you buy a house, let's say you pay $1 million for a house, unless you use inherited money, let's say, and pay all cash, most people have a mortgage. And so by putting down $200,000, you're leveraging your money. The same concept applies here, is that by paying some tax now, and especially taking advantage of the low tax rates that we're going to continue to enjoy through 2025, unless they change the tax laws sooner. By doing that, you're paying a smaller chunk of money than you're ultimately going to pay down the line when you take into consideration all the appreciation you're going to have on your plan assets.
Yeah. So there are some other benefits to doing a staged Roth IRA conversion plan?
Yeah, there are. There's 5 other benefits. One, and this is a biggie, you're going to reduce your required minimum distributions beginning at age 72. So by doing that, that's going to obviously result in less taxation to the extent that you take just required minimum distributions and don't take additional funds. Second benefit is you could potentially reduce your Medicare Part B and D premiums because those are dependent on income. So to the extent you have higher required minimum distributions, it's going to be more likely that you may have higher Medicare premiums. Another one that's not often talked about, but it's pretty significant, is to reduce widow or widower's income tax liability. Fourth is to reduce your dependency on taxable assets in retirement to the extent you have Roth IRA assets and you're not forced to use your taxable assets. That's a good thing. And last but not least, you'll reduce taxable income for non-spouse beneficiaries.
So a lot of folks might be thinking, I get the idea of doing a Roth IRA conversion plan, but maybe I should wait for the market to decline even further before I do this. Any thoughts about that?
That's a natural question. That's a common question that I get. But yeah, one of the benefits of doing a staged Roth IRA conversion plan is that it's done in stages at opportune times. So if you have a decline of 15% to 20%, or more, as in the case of the NASDAQ, that is an opportune time, and the goal should never be to time the market. The nature of the staged Roth IRA conversions are such, generally speaking, when you think of staged Roth IRA conversions, as I said earlier, you're thinking of doing them over multiple years. However, within a single year, let's say you do a staged Roth IRA conversion today, and then the market goes down further, there's nothing to stop you from doing one or more additional conversions in the current year.
Right. And you, as you sort of hinted at, this window of opportunity won't last forever. Markets do tend to rise after they've fallen. Talk more about that.
Yeah, a perfect situation with that is the example that I cited earlier. With a year ago, the S&P 500 declined 34% in 1 month. That's quite unusual. Once again, that was the shortest bear market in history. However, the point is you never know when the market's going to turn around. So the point is to look for opportune times to do your Roth IRA conversions, and and just keep it on your radar. And because the bottom line is, when you look ahead, depending upon what age you are, but I recommend doing these staged Roth IRA conversions beginning in your 40s, 50s, certainly once you get into your 60s. And so the whole point is to look ahead, and why wait until you're 72 when the value of your assets has potentially doubled or tripled, maybe quadrupled in value, to pay taxes on inflated values? Why not prepay some of it now? And that way, the goal is to have greater after-tax spendable income during your retirement.
Yeah. So one just quick follow-up, Robert, is when you look at your IRA account and you look at the various investments inside the account, I know we've spoken broadly about the S&P 500 and the NASDAQ. It may be that a certain mutual fund or a certain stock that you own is down, particularly more so than other investments. Would you look to sort of isolate those investments and mutual funds that are down more than others in your portfolio for the Roth, to target for the Roth conversion?
Assuming that they're equity investments, which generally speaking, they probably would be, those are the assets that I target for Roth IRA conversions, because those have the greatest probability of increasing in value over time.
Well, Robert, as always, I want to thank you for sharing your knowledge and wisdom with our readers and viewers. It's always so greatly appreciated. Thank you.
It's always my pleasure, Bob. Thank you very much.